Thank you, Mr. Chairman. And I certainly want to thank you and the witnesses for your time here today. The 30-year fixed-rate mortgage has been the primary American mortgage financing instrument for many decades. But from a lender's perspective, it's a very difficult loan product, assuming a reasonably low 30-year fixed rate. Carrying a particular individual borrower's credit risk for 30 full years is a particularly difficult proposition. And a 30-year fixed interest rate loan is also subjects the lender to 30 full years of interest rate risk and a 30 full years of inflation risk. Even if the borrower fully performs, inflation over 30 years can effectively reduce or eliminate the lender's real inflation-adjusted returns. Meanwhile, both increasing and decreasing interest rates over 30 years can negatively impact the lender, as many of you know. Increasing interest rates leave the lender with capital tied up in long-term assets that produces lower returns than those available at the higher subsequent market rates. Decreasing interest rates lead many borrowers to refinance and return the lender's capital when the lender's capital redeployment will likely result in lower returns than those that had existed under the original loan. To help deal with these and other problems, the Federal Government and the American housing finance system developed the GSEs and securitization. Lenders could now always transfer mortgages directly or indirectly to the GSEs or to private investors while also having access to GSE credit default guarantees. So lenders could offer mortgages with reasonably low 30-year fixed-rate interest rates while diminishing or eliminating long-term credit risk, inflation risk, and interest rate risk. The system worked reasonably well for many years. However, beginning in the early 1990s, the Federal Government went much further in promoting home ownership by pressuring the GSEs and private sector lenders to substantially reduce traditional underwriting standards and by turning the GSEs into the always available market outlet for lower quality loans. Over time, more and more lower quality loans entered the system. Inevitable increasing default rates led us to the financial crisis as the mortgage-backed asset values decreased suddenly and dramatically. Mark-to-market accounting immediately degraded the bank capital ratios, and the credit market fear and uncertainty quickly imperiled liquidity and solvency. Housing prices had declined severely, and the Federal Government made the American taxpayer liable for hundreds of billions in GSE losses. And now those same troubled GSEs that exposed taxpayers to so much liability are essentially the only remaining market participant in the mortgage industry, as private sector lenders and investors have abandoned the field. So we need to somehow create the conditions for more private sector entities to re-enter the mortgage market, diminish the taxpayer liability risk, and stabilize the housing market. I look forward to hearing your testimony today, and I appreciate your time. Mr. Chairman, my time's up, and I yield back.